Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Demetri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon's tools and products. With that, one last look at the webinar. We'll add Demetri to the stage. Good morning, D. How you doing?
Good morning, Will. How are you?
Great. So today we're going to talk about stock behavior around earnings. Is that correct?
Yep. We're going to take a look at a screener. This was based on a question that I got on an email. So let me share my screen first, so we could go to the screener. One sec. Let me know if you see my screen. And the question dealt with how to screen for stocks that behaved a certain way before earnings, and it could be during earnings or after earnings. We have a tool that looks at historical behavior around an earnings event. It tracks how did a stock tend to perform heading into the earnings announcement, how did it behave after it announced earnings, and then just leading out of the earnings announcements. And then the idea behind the screener is to look for stocks that perhaps tended to display a certain type of behavior. So we're going to take a look at that right now. Now, to get to the screener, from the main page, go to the earnings tab up top, and then go to earnings stock pattern screener over here. Click on it, and then you will come to this page over here. And this looks at just the stock behavior of the earnings. This isn't looking at options. And up here we have different filters, and then we have the table with the analytics and statistics below. So let's go over the table with the analytics first, and then we'll do a screen. So over here, you can see from left to right, we have these rows, over 66,000 rows actually of data. It starts with the stock symbol here with its market cap. If you want to know more about the stock symbol, you could click on this informational sheet. It'll pop up, and then you have more information about this particular stock that you can tab through in here. But I'm going to close this. And after the market cap, we have the statistics of how the stock behaved around its earnings. Okay, and first we define a time frame. So with that we mean we have an earnings event. It could be a certain day that's either announces before the market opens or after the market closes. So if we use that as our anchor, our date that we're analyzing, we have to define what range are we looking at. Starting if we're looking at a particular return, right? Are we starting before, ending after, starting before, ending before, starting after, ending after? What are we looking at? So this defines a time frame over here. So here it says the day of earnings opening gap. You can see this is 2 days after earnings, so starting after, ending after. So you could hover over, and it explains to you the time frame. So the opening gap in this situation is looking at how did the stock close before reported earnings, and where did it open right after it reported earnings. Okay, so even if the stock or company reports after the market close, it'll look at where did the stock close right before it reported earnings, and where did it open the next day. If it reports before the market opens, it'll look at the previous day's close and that day's opening price, because it reports before it opens, and then where did the stock open. Then here it tells us the number of observations that these statistics were calculated on. Okay, so here it looks at the last 12 earnings observations. So earnings, you have them once a quarter, so 4 times a year. So this would be three years of data in this analysis. Okay, where you could look at and change in here. So then we have the statistics. So what happened on this particular opening gap in this stock, right? So A here you can see is Agilent Technologies. So the opening gap, 50% of the time, the stock opened higher. Okay, so 50-50. Half the time it opened higher, half the time it opened lower. In those 12 observations, how did it do on average? So even though half the time it opens higher, half lower, let's look at the statistics and see, if it tended to move by a bigger magnitude in one direction, then the averages would get skewed, right? So if half the time it opened higher, but if it opens higher by, a lot, and when half the time when it opens lower, it opens lower but not as big a magnitude, then the averages will get skewed up or down. So here it says that on average, the returns were down 0.5%, indicating that the magnitude of the down moves exceeded the magnitude of the up moves. Okay, the downside was more volatile than the upside. If we look at the median, half the moves were above this amount, half the moves below. It's also 0.5%. So it's just showing us that yes, the moves to the downside tended to be bigger than the moves to the upside. If we look at the most extreme moves, though, up and down, the best move to the upside was 10.8%, worst to 10.6%. So those extreme levels you could see are very close together, about 10.8, 10.6%. So that gives you an idea of the potential moves to the upside or downside from a historical perspective and what it tended to do at the open. The standard deviation of the moves around the average, 6.8. And the Sharpe is just taking your average return divided by the standard deviation. Okay, so in this case, it's negative because the average returns were negative. So that quickly gives us an idea of the behavior of Agilent at the opening. Right, that's how that it behaved at the opening. Over here, this also gives us an idea when the next earnings are, and if you were replicating this type of, if that's the strategy that you're trying to target, it lets us know how far away it is to that next earnings. Okay, so it'd be like to replicate this, May 22nd to May 23rd estimated. So EST is estimated because we didn't pick up that they announced their next earnings yet. So this way, if you're looking at a particular strategy, let's say run up into earnings, and you wanted to see if anything is coming up in next week, 2 weeks, you could screen for that. Okay. So let's now look, take the screener and look for something that maybe we want to look at tendencies of a particular stock that behave a certain way. So let's say we did a time frame. Let's say we're looking for time frames that over here are available for stocks that maybe tended to run up into earnings 2 days before. Let's say 2 days before earnings, and this would be prior to the earnings. So this wouldn't include the earnings date. It just looks at 2 days before the earnings and closes out at the end of the day before the earnings are announced. So it's looking at how did that stock behave? Was there a run up? Was there like a demand to buy stock? Was there a demand, to get out of the stock? Like what did it tend to do? How did that trading crowd behave historically? And in the last, we have 12 observations here. And let's look at a historical win rate that's higher because we're looking for something that tended to run up. All right, that's what we're trying to find. So we're going to use this win rate to see stocks that tended to run up more often than not. So let's give it a 70% win rate. Okay, so I clicked on 70% here. So now you could see over here, we have a list of symbols, 283. These are sorted alphabetically, but let's sort it by market cap. So if you click on the market cap, you can see those sort highs to lows, lows to highest. So now we have these list of symbols that tended to run up 2 days before the earnings. So you see UNH over here. If we open that, United Healthcare Group had it historically in the last 12 observations, 75% of those observations, the stock was higher for that two-day trading period. And the average return was 0.4%. The median return was 0.7. The best return was 2.2. The worst return was 3.3. So you could see that when it was down on the downside, it exceeded the best upside move by 1%. But that was also offset because there were more times that it was higher. Standard deviation of the moves around the average 1.7. So if we take average return standard over the standard deviation, you get a sharp 0.23. So that's quickly looking at a screener that had a 2-day intended to have a 2-day run up into earnings, and now we get a list of those. So this is Disney, Goldman Sachs. You could see which stocks tended to do that. And if we wanted to look at the ones that are coming up, we could see how far away those are coming up for a 2-day, 2-day run up. So we don't know what's going to happen. Obviously, going forward, this is looking at a historical tendency, right? These are what happened in the last 12 quarters. And of course, you would still need to have a bullish outlook on this particular stock, because that's what this is looking at, a more of a bullish outlook in the 2 days run up. Now, let's say we wanted to see something that was coming up that fit these parameters, right? Let's say that fit these parameters, something that was coming up. So the next time frame start date, let's say if anything's coming up in the next 5 days. So here, now we have a list of stocks that met these historical parameters, right? Like Lulu, WSM, all these. You can see they met the historical parameters here. and the earnings are coming up, that in the next 6 days, this would be the time frame. Next 6 days in Lulu. This one, it's already past the start time frame. You'd be just looking at the ending time frame here. But this over here, you could see, would be stocks coming up that meet this particular historical tendency. All right, and then obviously you still want to go in or analyze these stocks, make sure you have you still have a bullish outlook in it, see how the options line up. It could be a candidate for bull call spread, or other types of strategies around earnings that would fit your outlook in this criteria.
Hey, D?
Yeah.
We just had someone pop in. Could you just show how you got to that screener, how you get to this screener again?
So from the main page, okay, up top, you have this menu. If you hover over the earnings, and then you go to the right, earnings stock pattern screen.
Awesome. And Rob was asking, there's a Sharpe Ratio option there. He's asking, does Sharpe Ratio have any relation to implied volatility? Does a higher Sharpe Ratio mean lower IV? That's his question. Is there any relation between Sharpe Ratio and IV, I guess?
Yeah. So no, in this situation, we're not looking at options at all. This is only looking at the stock behavior. And what this Sharpe Ratio here is doing is taking two metrics. One is the average return. Okay, so the average return in these 12 observations in Lulu was a positive 0.9%. Okay, so you had negatives in there, you have positives in there, so the stock, could have been up 1%, down 1%, up 3%, down 5%. So you have 12 observations in there, all right? What is on average? What was that return? In other words, like if you risked $1,000 worth of stock, all right, each of these observations, all right, what was the average return per observation? That was 0.9%. Let's just say 1% to make it easy. All right. So if on average it was 1%, how much volatility was around that average? So we want to ask, okay, if it was 1% every time, then there's no volatility, right? Then that means that, okay, every time you did it, you just made 1%. There were no losers. There's no volatility around. So that would just be, consistent 1%. But that's not the case. The stocks are volatile, so you could have volatility in there where you're like, zero, half the observations were 0, half the observations were 2%, or, half the observations were, down 10%, half up 12%, or you have a lot of variability there. So how risky was this strategy historically, that it yielded a 1% return? That's important. So to do that, we take the standard deviation around that average, right? The standard deviation around this return, which was 3.2%. So how do we then create a metric of, the return relative to the unit of risk, right? So how much, that's what we're looking at, the return versus the unit of risk, which is the average return versus its standard deviation. So you take the average return of the stock over the standard deviation of those returns, and then you get this Sharpe. So a higher number would obviously be better because you want a higher return, like let's say a very high return with no standard deviation. It's just always high, and there's no variability, just like consistently this, right? And we don't know going forward. We're just looking at it from a historical perspective. How did it do? Right. So over here, for example, this one, was higher. This one was higher because it looks like it had more positives than this one, and the return was greater, for the same, almost the same standard deviation. So, and this also is a little bit skewed because you can see the best return was 10% to the upside. The worst one to the downside was negative 1.8%. And always keep in mind, we're looking at the historical numbers to give us the perspective, the historical movements, the ranges, the volatility, as guidance. You'd still have to do your research going forward. What's different? What changed? How did the markets line up, and so forth. But that's what this Sharpe ratio is. It's only looking at the stock returns. Implied volatility is different. That's a metric that you're deriving from option prices. This is not looking at option prices at all. It's only looking at stock returns. So hopefully, that answers that question.
Yeah, that was awesome, D.
Okay. Now, when we're looking at time, of course, I did pick a time frame 2 days before. But you could let me unfilter some of this, and we could also look for similar situation. Let's say after. Let's say we observed that there was a earnings announcement, whatever it was, good or bad, or we observed and we're interested in how the stock behaved following the earnings announcement. Now that the stock got a chance to get repriced, there was an earnings announcement. There were new data points. The management had a time or a chance to have a conference call, answer questions, and so forth. So let's say the stock gets repriced, and we believe that first day markets are efficient and reprice that information. So how does the order flow then move on from there? Does the stock tend to move higher, to move lower? So we could take a look at that, like a 2 day after, right? So let's say 2 days after. And now we have stats here for stocks with how they perform 2 days after earnings. Okay. And you could see here, UNH popped. I have it sorted by highest market cap. We have UNH, Netflix, and so forth. They have tendencies to move up after earnings announcements. Okay. Here we can see just by looking at the Sharpe, very similar. Netflix, UNH. This one's a little bit higher. Here we see that UNH on average was up 1.3% after announcing earnings. So this is not including the earnings date, right? So let's say the earnings are announced, in the morning, whatever it is, or whatever it is in UNH, and whatever the stock does that day, close up or down. So if we use that closing price, end of day closing price after earnings, how did the stock perform the following days? So it starts end of day after earnings, and then let's say and then for 2 day hold. So you could see here, on average, this was up 75% for 2 day hold post earnings. These are post earnings. Netflix post earnings 83% in the last 12 quarters, and so on. So Netflix, very similar, up 1.9%, 2 days post earnings. Median return up 1.7%, best return 6.3, worst return 4.7. So it still has volatility, you see, 2 days after, you got a 6.3% upside move, 4.7% downside move. So you have volatility, standard deviation of 3.2%. So if we take that average return over standard deviation, you had a 0.6 Sharpe ratio. Okay. And just going to the left, this is a 21 days till your next earnings. Okay. And days, if you wanted to do that, 22 days to next start date, end date, 22 days away from an opening and closing to mimic this time frame. Okay. So I think I covered a decent amount today. I'm going to stop there with the screener.
That was great, D. Thanks for that webinar. That was awesome. Chameleons are very thankful. Thank you to everyone who joined this webinar today. Great job as always, D. Remember to like us and follow us, Facebook, LinkedIn, YouTube, Twitter. We're on them all. Great job, D.
All right. Thanks, everyone. Stay safe out there. Have a great trading day. And we hope to see you tomorrow.
Trade in peace, Chameleons. Everyone have a great day. Bye.